Algorithmic trading is revolutionizing the investment world. In this video, I will introduce you to a program that generated an average of 7.93% per month in a hypothetical trading account. I will also demonstrate how this system could have been used to generate, on average, approximately $1,317 per month from a $15,000 trading account going back 22 months. Finally, I will show you an allocation model that had a hypothetical account grow from $15,000 to just over $90,000 in that same period, using a more aggressive compounding allocation. Before I get too far ahead of myself, I'd like to mention the disclaimer that you'll see on the bottom of the screen. Please refer to this disclaimer and remember that I'm going to be speaking of the many positive reasons why someone would use this system, but that it's not for everyone. Past performance is not indicative of future performance, and there's a substantial risk of loss in trading futures and options on futures. I would also like to emphasize that the returns shown here are taken from live trades that the individual algorithms place, but in different packages such as the Geronimo options algorithm and the professional trader package. Back to the question, why would anyone use this program? The answer is quite simple. The returns seen in live trades compiled into the hypothetical account is the primary reason. Here's a snapshot of the returns seen per month on the Geronimo Trading System. This data assumes a single unit, or $15,000, was traded throughout the entire period shown. Therefore, to convert the numbers seen to a percent return, you would have to divide the dollar amount shown here by 15,000. As an example, in March of 2021, the algorithm returned $1,677 per unit traded, or 11.18%. Feel free to pause this video at any time if you'd like to take a longer look at any of the charts I'm providing here. These positive returns set our customers up with a few different ways to capitalize on the strategies we provide. You'll need to do your own research and analysis to determine what the best way for you to utilize the algorithms are, but I would like to show you a few possible implementations. Just remember, I'm not a CTA, and this is general advice, not unique to any individual's situation. These algorithms should only be used with risk capital. Usage Model 1 is also considered the normal allocation. This allocation is used to display the returns in a normalized form. This allows me to show the raw results of the algorithm without taking into account any compounding effects, since that can drastically affect the results seen. In this normalized allocation, one unit is traded the entire duration. The primary result of Usage Model 1 was that a $15,000 account, which would have begun trading in April of 2020, would have grown to $41,178 as of January 2022. Usage Model 2 is displayed to show the result assuming someone withdrew all profits made at the end of each month. Therefore, this allocation can be thought of as a cash flow kind of allocation. In this model, the account balance stays at your initial investment size, and at the end of each month, you withdraw any profits above your initial investment. The primary effect of Usage Model 2 was that for every $15,000 traded, the algorithm would have returned on average $1,318 per month. Just keep in mind that this is the average taken from a hypothetical account. It does not mean that every month you automatically are profitable. Some months return more, others return less or have losses. But the overall average return is $1,318 per month per $15,000 traded. Usage Model 3 is also called the Rapid Account Growth Model. In this model, you increase the number of units traded at the end of each month based on the per unit trade size, or possibly using a more aggressive allocation of 1 unit per $10,000. The primary effect of Usage Model 3 was that a $15,000 account starting in April of 2020 would have grown to approximately $93,360 as of January 2022. This usage model demonstrates the power of compounding. Just keep in mind that this is a very aggressive allocation, and it's taken from the hypothetical account, which was able to increase the number of units traded with every $10,000 in profit. Let's take a closer look at usage model number 1. This chart shows that if someone started with the minimum account size of $15,000 and was trading 1 unit throughout the entire duration, 1 unit meaning they traded as if they had $15,000 each month, their $15,000 account would have closed January 2022 with $41,178. The total return would have been $26,178, or 174.52%. Please keep in mind that these kinds of spectacular returns do not come with zero risk. However, the Geronimo Trading System is designed to minimize risk by using put spreads, which cap the max loss on any given trade, and using day trades on the S&P E-minis, utilizing tight stops the entire time. The largest drawdown seen in the same period has been approximately 18%. In duration, it was between May and July of 2020, and the total drawdown seen in that 3-month period was 12%. As a reminder, I'm still talking about usage model number 1, and I'm providing the reasons why someone might choose to use this product. With that in mind, this graphic is another very good one to take a close look at. This shows each month's profit or loss along with the percent gain or loss in table form. The best month seen using this algorithm was a gain of 50% seen in October of 2021. The biggest loss seen in the period under analysis was a loss of 18.7%. The other 3 columns show how the system performed while trading for the indicated durations. This is helpful because it shows the best and worst percent gains for the period indicated. How is this helpful? Suppose someone was curious what they might expect after 3 months of trading the Geronimo Trading System. This data demonstrates that in the hypothetical account, the worst performance seen was down 12%, but the best return seen was up 79%. This provides a range that can help provide some grounding in expectations, and after you've traded for a few months, allow you to compare your return seen with what our past performance expectations have shown. Just remember, past performance is not indicative of future performance, and consider carefully CFTC Rule 4.41 below as it pertains to hypothetical accounts. A few other observations can be made from this data. Notice as the time period increases, the average profit loss also increases, as does the winning percentage for each duration. This brings me to an important point, namely, if you decide to sign up, you should take a long-term view as you gauge the performance of the Geronimo. For example, if you sign up and your first month is down, you can take a bit of comfort in knowing that 36% of the time we will have losing months. As the time frame increases, in other words, you trade the system longer, the win rate for that roll-in period increases. The average gains one might expect to see will also increase. And as this data shows, if you can wait for at least 6 months, that's ideal, since for any given six-month period, the expectations are that 88% of the time you'll be up and up a substantial amount. Usage allocation number 2 is the second usage model. This one is designed to generate cash flow. Please remember there's no guarantees that your account will see positive returns. That said, the data I'm providing is taken from live trades that were placed in systems my company has offered. However, this data should be considered hypothetical. Feel free to pause the presentation so that you can review this data. It might look a little confusing, so let me try to explain what it shows. This model is demonstrating how cash would have been generated as the algorithms traded. At the end of each month, the account owner would have removed any capital from their account which was above their initial deposit of $15,000. For example, in March of 2020, the account is opened and funded. In April of 2020, the algorithms returned $4,259. Therefore, at the end of April 2020, the owner would have withdrawn any profit above their initial account size of $15,000, or in this case, all profits made in April, which was $4,259. This also shows their account balance, which you'll see is never more than the initial they deposited, since any gains are withdrawn at the end of each month. Notice in May of 2020, the algorithms had losses of approximately $595. Therefore, their account balance at the end of May 2020 was $14,405 and no cash was withdrawn since their account balance was not above the initial deposit of $15,000. The algorithm saw some losses in June and July of 2020 as well, but then delivered solid returns in August of 2020, bringing their account balance easily above $15,000 and allowing them to withdraw the excess, which amounted to about $181. This process repeats itself, and as the algorithms do well, the account owner would withdraw the profits and continue trading one unit. This data can feel a bit overwhelming, so I'd like to also simply summarize the total returns or cash withdrawn from the account, and in the case of the $15,000 starting account size trading one unit, the algorithms would have allowed the user to withdraw a total of $28,983. The average return per month in this case is approximately $1,317 per month, or 8.78%. Finally, the third usage model is also called the aggressive growth model. As I mentioned, the returns shown up until now have been from a single account trading one unit the entire time. This slide shows the returns in the hypothetical account, assuming that somebody compounded their returns under the most aggressive allocation. In this example, the same account would have grown from $15,000 to approximately $93,360 in 22 months. In this aggressive compounding strategy, the account owner would have increased the number of units they are trading by 1 for each 10,000 in their account, and they would continue trading that number of units until their account was able to trade a higher number of units, at which point they would increase again. As I mentioned before, there's always risk of loss in trading futures, and compounding in an aggressive manner like shown here does carry risk of loss. This slide gives a summary of the different usage models I've shown so far. As a reminder, I'm currently answering the question, why would anyone use our algorithms? These kinds of well-designed algorithms provide lots of different potential, as the data has shown. Someone could use them to simply grow their account, to rapidly grow their account using one of the aggressive compounding allocations, or they could use the algorithms and simply withdraw profits at the end of each month. As I've already mentioned, I'm not a commodity trading advisor, and so the choice is really up to you as to how you might utilize these algorithms. No matter which usage model you choose, the algorithm is the same. That is, we're all trading Geronimo. What changes between the different usage models is simply how many units you're trading and how often you prefer to withdraw funds from the account. If this video has piqued your interest and you would like to receive pricing or any other information to include how to get started, then please respond to the email that we sent you with your contact information and any additional questions you might have, and we'll be in touch with you shortly. Getting started with automated trading is quite simple and there's really no experience required. Thanks again for watching the video. I look forward to speaking with you and answering any other questions you might have. Have a great day.